A rally on a record, 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, trade optimism is in the air. Global stocks rally on news that U.S. and Chinese negotiators have found common ground on a range of issues.
And the bull market faces a make or break week with tech powerhouse earnings on deck, plus a Fed decision on Wednesday.
And deals. Huntington scoops up a smaller rival. Nelson Peltz eyes a Janus Henderson buyout, while Keurig Dr Pepper lands funding for JDE Peet's from Apollo and KKR.
Already a really busy week just based on the deals, and it's about to get even more intense for this market. A quarter of earnings coming in the form of the big tech giants. 2 days this week. It's likely to dictate the entire direction of the stock market, maybe for the remainder of the year. 5 of the Mag 7 stocks will be reporting earnings on Wednesday and Thursday, with investors looking for any signs of return on AI spending and plans to hire top AI talent. We'll also hear from Apple and Amazon, but all those shares surging in the pre-market, Matt. Microsoft got an upgrade from Guggenheim today, and now 99% of analysts have a buy rating on the company.
Wow. All right, we'll take a look at that throughout the program. Going the other direction, rare earth stocks on the move after Treasury Secretary Scott Bessent said that he believed China would delay its rare earth restrictions for a year. As a result, all of these stocks that the market's been betting big on lately are down across the board. Dani?
And that's dictating the entire direction of an up market today. Let's get more into it. Chinese and U.S. trade negotiators have lined up diplomatic wins for Presidents Trump and Xi Jinping to unveil at a summit later this week. Here's how Scott Bessent says it came together.
President Trump gave me a great deal of negotiating leverage with the threat of the 100% tariffs on November 1st, and I believe we've reached a very substantial framework that will avoid that and allow us to discuss many other things with the Chinese.
Joining us live from Tokyo is Bloomberg Washington correspondent Tyler Kendall, where she's traveling with President Trump. Tyler, we have a positive setup. What are we expecting this week?
Yeah, hey, Dani. Well, it really feels like we're seeing a cooling in the tensions to keep the conversations going about a potential broader trade deal. Now, as you mentioned, it appears that both sides are teeing up some of these diplomatic wins for President Trump and Chinese President Xi Jinping to finalize as they head into their face-to-face meeting on Thursday. Importantly, this week, we're likely going to see an extension to the trade truce that's currently in place and set to expire on November 10th, as the U.S. Treasury Secretary went on to say that that threat of an additional 100% tariff is off the table for now, seemingly in response to Beijing delaying its implementation of proposed export controls related to critical and rare earth minerals. The Treasury Secretary also said that we're expecting China to resume its purchases of U.S. soybeans, though we have yet to get details on how much or how quickly that will happen, as analysts say that China has actually front-loaded its purchases of soybeans through the end of the year, so perhaps relief won't be as immediate as this administration wants. There's a few other concessions that we might hear about, including that China has said that the U.S. will no longer impose fees on Chinese ships that are docked at American ports, and our own analysts at Bloomberg Economics estimate that the U.S. will likely take off the table some of the threatened but not yet imposed restrictions when it comes to the advanced semiconductor supply chain related to software and also cloud computing. Dani, there's a lot on the table and a lot that still needs to be finalized, but it really feels like we are toning down the tensions that we've seen escalated in recent weeks. I'd say I'm keeping my eye on what happens around that 20% tariff related to fentanyl. That is the one area here that is not new. That tariff has been in place since back in February. In fact, it was one of the first tariffs actually implemented, and we've seen both sides say that they're making positive momentum when it comes to the issue.
Of course, none of this will be finalized until Presidents Trump and Xi meet face-to-face. We've been waiting for this since the election. What do we know about the tick-tock of this meeting? When is it going to happen? Where is it going to happen? And how long will it last?
Well, Matt, it's going to happen on the sidelines of the APEC summit on Thursday. And I would actually point you to what is happening ahead of time and how the U.S. appears to be trying to gain leverage going into these talks, even as we get these positive indications from both sides that they are making progress. Just look at the critical mineral deals that President Trump signed during the ASEAN summit, which he was at over the weekend in Malaysia. Of course, a bid to try to shore up the supply chain with the U.S. and counter China's grip on the global market. And then he's in Japan before he heads over to South Korea. While he's here, he's expected to host a reception with business leaders. We know investment is top of mind, as Japan had pledged that $550 billion investment fund as part of its deal to receive that more preferential rate of a 15% tariff. I have to say, every local Japanese newspaper that I picked up this morning, the main headline was that the U.S. and Japan, according to local media reports, will enter into a shipbuilding cooperation agreement. Again, another critical industry that the White House is trying to shore up ties with as they try to compete and head into these broader negotiations with China later in the week.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall reporting there live from Tokyo. Now, let's turn to a number of deals on the corporate front this Monday morning. Regional lender Huntington will buy Cadence Bank in an all-stock deal, valuing Cadence at $7.4 billion. Bloomberg Intelligence senior regional bank analyst Herman Chan joins us now. So Huntington Bank, out of the great state of Ohio, making moves in Texas.
That's right. It's a deal that really brings the Houston market in particular and also fills in some smaller markets in the Southeast that will really propel Huntington forward. That Huntington talked about increasing their return on tangible equity by about 200 basis points. So it's going to be a deal that really improves profitability and expands further into the Texas market after the Veritex deal that was just closed last week.
Yeah, it was, to your point, they literally just did a deal, and we were showing a screen basically of all the regional bank deals that have happened so far this year. Herman, it has a feeling like the floodgates have opened.
It really has. And for a bank like Huntington to be this aggressive, 2 deals in 2 years, whereas they've been much more conservative with tie-ups by the current management team. So it feels like something's really happening with bank M&A. There's been a lot of regulation easing with tie-ups. You're getting deal approvals at a much faster pace, and you've seen deals from a lot of these larger regional lenders like a Fifth Third, like a PNC. So we expect more to come.
Right, Herman, thank you so much for covering them for us. That is Herman Chan of Bloomberg Intelligence. It's been a busy day for deal news. We also learned that Nelson Peltz's Tryon Fund is working with General Catalyst on an offer to buy the rest of Janus Henderson that it doesn't already own. Bloomberg senior deals reporter Michelle Davis joins us now. Michelle, a great scoop from the team. What's the thinking behind the playbook from Nelson Peltz to buy the rest of Janus Henderson?
So this is really an AI play, and it's a continuation of Tryon's investment in Janus Henderson. They've been in the stock for 5 years, helped oust the CEO, and now the view is they want to partner with General Catalyst, which is a well-known, tech VC investor, to basically help the company adopt AI and maybe generate better returns than they have now.
There are a lot of deals, as I said today. Novartis is in for a $12 billion deal as well. I guess there's a lot of corporate confidence out there.
There is. I mean, when the stock market's up, it makes sellers more open to selling, and it also gives buyers confidence and, more currency to do M&A with. The interesting thing about this Novartis deal is it's their biggest deal in 10 years, biggest deal under the current CEO, and it just continues this trend of, big pharma companies needing to buy smaller companies with a lot of innovative drugs to boost their pipelines.
Well, it's one specific sector, and it's a clear catalyst that you're talking about, but we're talking about asset management, regional banks. What is the overall catalyst that's given these companies in corporate America the all clear to go ahead with a lot of these deals?
Well, and to your point about sectors, there was also a massive water utility deal, so it really runs the gamut. And I think it all comes back to confidence, as we were talking about, and just this view that regulators under Trump are going to be more lenient, and investors seem to really be liking M&A. Shares are going up after M&A announcements. So it's like a FOMO thing, deals beget deals. The more you see it, the more you'll see more of them.
Shares are going up after deal announcements, but not after earnings beats. And I think that tells you something.
Right. Well, because of revisions, and we're going to talk about that throughout the show. Michelle, thanks so much for joining us. Bloomberg's Michelle Davis covers M&A for us. Quick check on what's going on in terms of futures. You saw they were up across the board, and they remain pretty decent here. S&P futures up about 0.9%. NASDAQ futures up 1.3% because we have a ton of the big tech. I think 5 of the Mag 7 companies reporting this week. We already had Tesla and, we don't get Nvidia usually until months after earnings season.
November 19th?
Exactly. It is November 19th. Yeah, but they're always coming so late in the game.
Yeah, well, we do have some single stocks moving, though, ahead of that. Beyond earnings, Lululemon shares are on the rise. They entered an agreement with the NFL and Fanatics, a sports merchandiser, to develop a line of fan apparel as the yoga wear retail searches for new avenues of growth. They've really been struggling. They need this. They've also signed on a lot of athlete spokespeople as of late, including a very, in my opinion, successful campaign with Lewis Hamilton.
All right, I haven't seen that, but I will take your word for it. Keurig Dr Pepper raised its sales outlook as the price of coffee climbs, and investors await more detail about its acquisition of JDE Peet's in terms of the financing. We got a little bit on that today.
Yeah, little deal news. Apollo and KKR helping in an investment for that spinoff. Meanwhile, Newmont shares, they are dropping 4.5%. The miner is looking into a deal to take over Barrick Mining's Nevada gold assets.
Coming up, Javier Milei's party won Argentina's midterm vote in a major comeback. We're live from Buenos Aires on a story that's moving assets in a big way today. This is Bloomberg Open Interest. Let's get to high interest now. We'll look at what's making headlines around the world. Treasury Secretary Scott Bessent confirmed 5 finalists to succeed Federal Reserve Chair Jerome Powell, with President Trump, saying he'll decide on the new Fed chair by the end of the year. The list includes Fed governors Chris Waller and Mickey Bowman, also the 2 Kevins, as well as BlackRock executive Rick Rieder. Powell's term as chair ends next May. Cigna will scrap prescription drug rebates in many commercial plans starting in 2027, shifting to upfront discounts meant to cut pharmacy costs for patients. The move is in response to pressure from the Trump administration to end the so-called rebate kickback system. The change could reshape billions in drug pricing flows between manufacturers, insurers, and employees. And President Javier Milei's party scored a decisive midterm win in Argentina, giving the libertarian leader a solid grip on Congress to press ahead with sweeping free market reforms, cheered by investors and backed by President Trump.
The
Argentinians showed that they don't want to return to the failed model. Argentinians told populism to stop. Populism never again.
The victory, a sharp rebound from last month's Buenos Aires loss, sparked optimism in markets. You can see here what happened to Argentina dollar bonds, and President Trump says we made a lot of money on this election, Dani.
Let's get more on that. On the Argentinian midterm, joining us now is Patrick Gillespie, Bloomberg's Buenos Aires Bloomberg chief. Patrick, what did change between last month and this that allowed for this not surprise victory, but surprise considering the margin that Milei's party won by?
Dani, this was a surprising, and for the optimists, I think even a surprising outcome. Milei's party won 41% of the votes nationwide, and this really gives him a strong grip. As Matt mentioned, he's going to have 1/3 of the seats going into Congress. That protects his veto power and really gives him a lot of negotiating power to advance on structural economic reforms, on labor, tax, pension. These are issues that investors and I think a lot of people in Argentina have wanted to see for decades. So now there's a really special window of time to get some special changes through in Argentina. And what changed? I think the vote in Buenos Aires province about a month ago spooked people that there could be a return of the leftist policies that that Milei inherited when he took office 2 years ago, that obviously created inflation over 100% and left the economy in a crisis. And it's important to note that Milei won the province of Buenos Aires today. So clearly voters there had a big change of heart. And that is the most populous province in Argentina, with over 1/3 of the country living there. So really, Buenos Aires made a big shift in just a period of 50 days. And you also saw that Milei won in most of the provinces across the country, I believe 14 of the 24. So really a big historic win for Javier Milei. And now investors are going to want to see if there's going to be some policy changes on the horizon.
I mean, it's so exciting on so many different levels, Patrick, right? Because this means Argentina may be able to finally break the decades-long cycle of failed reforms and defaults. It also is a huge win for the U.S. because President Trump and Scott Bessent went big behind Argentina, and that bet is going to pay off not only financially, but also in terms of, I would guess, appreciation from the people of Argentina. And then finally, a lot of sharks were circling in terms of the shorts, and they're going to get hurt badly today.
Absolutely, man. You're going to see, I think, Javier Milei and President Trump continue to build that relationship. Whether the $40 billion rescue package will be needed at this point is a question, because we're seeing the bonds rally. The peso is rallying today. Treasury Secretary Scott Bessent signaled on Air Force One earlier today that he thinks markets will take care of itself at this point. And that the U.S. support was supposed to be always a bridge to these elections. So I think people are going to want to see if Milei can continue to strike a conciliatory tone with the centrist blocs in Argentina, especially the governors, to get some of those economic reforms passed. It's important to note he does not have a simple majority in Congress. That's what he needs to get these reforms over the finish line. So he's got a much better negotiating bloc to work with. He's got his veto power protected, but he still needs to work with the centrist blocs in Argentina to get these major reforms across the finish line.
Patrick, great to get some coverage with you. Bloomberg's Buenos Aires Bureau Chief Patrick Gillespie talking to us about really this incredible story unfolding in Argentina. Let's get a look at some of the other movers on our radar this morning. As we heard from Michelle Davis earlier, American Water Works will buy Essential Utilities in an all-stock deal valued at about $12 billion, expanding both companies' reach across 17 states.
And deals abound everywhere. Grinders extending gains that it saw on Friday after it confirmed a take-private bid from two of its largest shareholders. Those shares up nearly 2%.
And Wall Street analysts are now almost universally bullish on Microsoft, with Guggenheim upgrading the software company to a buy from a hold. As a result, now 99% of analysts that look at this stock have a buy rating. It's actually 72 of 73.
So it's like 98 point something.
6, yeah.
If one hold, zero sells on the thing.
Exactly.
Literally zero sells. I think the one hold is from Hedgeye, so the one like not bear, but like kind of meh on it. Speaking of which, coming up, we're going to talk more about earnings. RBC's Lori Cavlasina says backward-looking earnings are strong, but forward revisions aren't so hot. She's going to be joining the show next. Stay with us. You're watching Bloomberg. RBC says third quarter earnings are unlikely to bring a major lift to market sentiment. Strategist Lori Cavlasina says backward-looking earnings results are strong, but the ratio of companies reporting upward revisions is declining from recent highs for both the S&P 500 and Russell 2000. Joining us is the woman herself. It's RBC's head of U.S. equity strategy, Lori Cavlasina. Lori, great to see you this morning. Feels a little bit tricky, especially ahead of the big tech earnings, which everyone has been saying this is the thing that's going to keep the equity market afloat. You're a little bit more skeptical that the earnings are as big of a driver as others.
Yeah, and it's not that we don't think earnings are bad, right? Like, earnings are a very solid foundation here. And in fact, if you look at the bottom-up consensus, it's nudged up for next year from 305 to 306 because of a little bit of rounding. So, they're technically headed in the right direction. But we like to look at earnings sentiment. This is something I've been looking at for 25 years, my entire career as a strategist. And it's a good way to normalize earnings data between indexes, sectors, industries. Are you taking numbers up or not? Like, that's really all it's asking. And what we were seeing is that we had hit typical, kind of highs outside of the recovery on a major crisis in August, right? And that was kind of in the mid-60s for the S&P 500. So like 2/3 of your revisions were still to the upside. That has fallen down to about 52% in our latest update. If you look underneath the surface, the tech sector is sitting up at typical highs on that indicator. Every other sector has decelerated. Things like industrials and materials have actually fallen into negative revision territory. The Russell 2000 has actually fallen into negative revision territory. So it's just a way of saying, look, we had a tremendous amount of earnings enthusiasm and optimism in that last reporting season. It got about as good as it tends to get, and now it's coming back down to earth. It's going to be, I think, make or break in terms of what the tech companies do this week. The tech sector has been doing an enormous amount of heavy lifting.
We have, by the way, an amazing function on the Bloomberg terminal, EEG. I know you look at a 12-month rolling average of earnings revisions, right? The next 12 months. But if you look at EEG, you can see the past few quarters. Joe, can you pull it up? And here you see, you know, Q2, we jumped up, obviously, right before earnings. Q3, we also are coming up right in the last few trading sessions. But Q4 doesn't look that great so far, and it's clearly slowing down. I'm curious about the rest of the S&P versus the tech, right? Because I heard you telling Nathan Hager this morning on Bloomberg Radio that the rest, like the 490, right, is valued at 18 plus times forward earnings, which is pretty heady stuff.
Yeah, look, everybody's trying to say we're in this AI bubble. I think we have a valuation problem in the NASDAQ 100. I think we have it in the S&P cap weighted. I think we have it in the S&P top 10 names, which is, you know, Mag 7 plus a couple extras. You're trading at the ceilings that have marked kind of the last 10 years, not necessarily at tech bubble highs. But when we look at the rest of the market, so S&P x the top 10 names, you're trading basically at levels that have marked the peak every single time except for 2021. So I don't think that this is necessarily that we've got this AI bubble and the market has to correct. I think we've got an overvaluation problem everywhere, including these AI-related names that are also sitting at peak earnings revisions. Peak valuation, peak earnings revisions makes me very nervous.
All right, we're going to come back and talk a little about that because we touched on the 18 plus times valuations for the rest of the market, but I don't know that the Mag 7 looks that crazy for growth stocks. We'll get to it. We'll get to it. We have to take a break here. Laura Cavlasina is staying with us. A check on futures ahead of the opening bell. Not moving in the last few hours. They've been at these levels all morning long because we're rising on optimism for trade, because we're rising on optimism for these tech earnings, and there's a Fed meeting this week. We're back in 2 minutes with the opening bell. This is Bloomberg. We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at a rally on top of a record. We closed at a record high on so many indexes, including the S&P, including the NASDAQ, including the Dow Jones Industrial Average on Friday. And now we're up another 0.8%, 0.9% on the S&P, and at least in terms of futures, NASDAQ futures up 1.2%. We'll get to the small caps in a second because Lori takes a closer look at the small caps than a lot of strategists do. In terms of the bell ringers, you've got Moishe Gubin leading Optimum Bank there, celebrating their 25th anniversary. The stock has not done well this year. Over the past 5 years, it's up about 44%, so it's better than a stick in the eye, as they say. You could have made a lot more money if you were in Fortinet, even with the huge drop. They had like a 23% drop at the beginning of August after earnings, and still the stock is beating out the S&P over the past 5 years, just absolutely crushing it over at Fortinet. Dani, what stocks are you watching?
I'm watching the big tech. As Lori Cavlasina was saying, it is a make or break moment for earnings because you have Microsoft, Alphabet, Meta, all of them will be reporting. It's 2 days to dictate the entire direction of the equity market. It's 5 of the Mag 7 that are going to be reporting earnings Wednesday, and then Thursday alongside of it, investors are looking for any sign of a return of spending on the AI spending, rather. Apple and Amazon, they will also be reporting along with the ones you see on your screen, Matt.
All right, going the other direction, rare earth stocks after Treasury Secretary Scott Bessent said he believes China will delay its rare earth restrictions for a year. I don't know how this caught anyone by surprise, to be honest. And they are down, that looks like large numbers, 6, 7%, 15%, but they have been up so much recently, a lot of them exponentially. So I don't think this is a huge dent, really. We're back with RBC's head of U.S. equity strategy, Lori Cavlasina, and I just want to start off where we left off. The valuations of these big cap tech companies are like 25 to 42, depending on whether you're looking at Meta or Nvidia, but they're not huge.
Yeah, look, I think that when we look at the basket, right, of just the top 10 names in the median, we're trading in line with where they've topped out in the past, right? This is a self-imposed ceiling to some extent, and we actually haven't been getting any expansion in that median multiple since August. So that's something that's told me this market is very, very earnings dependent. But, you know, one thing, Matt, that comes up a lot in the discussions about AI froth, are they overvalued? We look at their PEs relative to their long-term earnings growth rates, and then we do the same thing for the S&P x the top 10. And what we find is that it's basically the relative PE and the relative long-term earnings growth are the same lines, right? So they're getting bigger multiples based on the earnings growth that's projected to be there. And there's a little bit of a gap in those lines. Maybe, you know, that relative PE multiple is a little bit higher than it should be based on the relative earnings, but it's not a ton.
So if they're not overly inflated, and you're also talking about this idea that earnings going forward aren't as bright and sunny, does any of it matter? Does any of it matter if we're inking deals with China that I realize are more of a standstill than a move forward? Does it matter with global central banks set to cut and to continue cutting with the Fed this week? Can we just keep moving higher regardless of what earnings are telling us?
Well, look, I'll tell you that on the issue of rate cuts in particular, I've been hearing about that issue since the summer, and people who told me they were bullish on the market because of rate cuts back in late June are now telling me that they think a lot of the rate cut price action has been pulled forward. So I think, you know, there are things, right, that are obvious tailwinds, but the question is just how much has that been anticipated? And I think that's what these kind of peakish valuations may be telling you, is that a lot of this good stuff is expected. I do think there have been maybe, you know, some more openings on the trade side than we realized. I mean, we saw the market take a pretty big hit when it looked like the China stuff was going south. Now that it looks like it's a bit firmer, you're seeing the markets react to that positively. But I'll tell you in general, Dani, I did not hear a lot of concerns about, you know, sort of the China-U.S. trade negotiations on the long list of things that people were worried about. So my guess is that has sort of limited upside.
Yeah, it's been said that the economies are so intertwined, it's in both countries' economic interest to make a good deal. I promised we'd talk about the small caps. You, in the past, have focused on small caps, a lot of your research, and you mentioned that the Russell 2000 earnings revisions have gone negative. I also noticed in your research that small caps, that the Russell is top heavy. There's concentration risk there. Just like we see in the S&P 500, which I didn't realize.
Yeah, it's something, honestly, Matt, we've been hearing a lot from our small cap PM clients over the last like 4 to 6 weeks. And I think the third quarter was very brutal, frankly, for a lot of active managers in the small cap space. And that concentration issue has made it very difficult for them to beat their benchmarks, in particular because the PMs have felt like a lot of the names that are up there are very low quality. And are
but what is it, like 40 companies make up 25% of the index?
It's, you know, I'd have to go back and check the exact stats, but we do know that that number has moved up while the revenue share has moved down. So it doesn't, you know, kind of look like some of those other gaps. It does look like there's a major gap there, even in terms of revenue generation. The percentage of negative earners among those top 40 names is also, I think, around like 38% or something. Like it's, I'd have to go back and check that stat, but it's also kind of crept up as well. And so I think it's creating these pressures. I mean, you're seeing areas like the quantum names are in there, some aerospace and defense, biotech. Not all of them are low quality, but there are enough of them that are, that a lot of managers look and saying, I can't own this stuff. It's running. It's just swelling in terms of my benchmark, and it's low quality to boot. So how do we even measure valuation? So it's really creating a big pressure point. One thing I'll tell you, Matt, is we put out a new chart in the weekly today where we looked at small caps versus large caps and mid caps, and we looked at the PEs in the context of ROEs. We have so many people who want to buy the small caps because they're cheap, but they actually have much, much lower ROEs than the big caps that are getting bigger multiples. And you know, you sort of see people are paying up for quality, right? Like that's what this market has decided to do. And so small caps really are disadvantaged from that regard. including their biggest weights.
One thing we haven't talked about of what we've heard from companies are their margins, and margins have looked pretty strong. For the S&P 500, we're running just below 13%. It's matching, if not slightly exceeding, what we saw in 2021. There was Keurig Dr Pepper today who said we beat not on volume but on price because consumers are paying more, despite the fact coffee prices are so much higher because of tariffs and weather-related issues in Brazil.
Brewers have the same story, right? Beer is the same story. They're not selling more beer, but it's more expensive.
It's everywhere you look, it feels like, in these consumer-facing companies. Can that last? Can margins last where they are? Will people keep paying up?
Well, we haven't run the stats through this reporting season yet. There's just too much going on. We've got 162 companies coming out this week alone. But we did look at how margin expectations changed between the end of June and Labor Day, basically. And you saw the S&P was flat and tech went way up. And then you saw the expectations around all the tariff-related stuff came down, especially in things like industrials and materials. And I have noticed, as I've read through some of the industrial reports, that we have seen people talking about margin pressures. So I think companies, they're making a heroic effort here to work around the tariffs to mitigate as much as they can. I mean, the snarky part of me says, why weren't they doing some of this, cost-saving stuff in the past, where we just sort of leaving all this earnings and margin on the table? And
they had it too good.
Yeah, now we're magically finding it because their backs are against a wall. But I do think they're doing a very, very good job. And again, we think that this foundation is solid, but can you match that same excitement we saw earlier this year? It seems unlikely.
All right, Lori, great having you here with us. Thanks so much for joining us. Look forward to our next time together on air. And it's always so special for me because she does Bloomberg Radio in the morning with Nathan Hager on the same day, so I get extra prep time.
It's like the best day you could ever want if you like to listen to smart voices on U.S. equities. Listen to Radio with Lori Cavlasina all morning, and then tune into Bloomberg Open Interest, where we have Lori Cavlasina.
Absolutely. Great programming note there. All right, let's get a check on the stock market right now, looking at some gains in the cash trade, just like we saw in futures, about the same amount here. And Dani, we're looking at 68.50 on the S&P.
Yeah, above 6,800, a new record after last week, which is the best week for U.S. stocks since August. We have 340 stocks up, 160 down. It is led by Nvidia. It's the deal optimism over China, where the leaders will meet. Xi and Trump will be meeting on Thursday after those 2 days of talks in Malaysia. Microsoft, Apple, both are going to have earnings this week, as will Alphabet and Amazon. Tesla already had earnings, but it's the Mag 7 crushing it today. On the downside, Eli Lilly down only 0.7%. Procter & Gamble down 1.4%. Newmont, that's a continuation of a decline that we saw on Friday over one of their bids for some Barrick mining assets in gold. Those are the individual companies. If you look again at the overall market so far this morning, Matt, we are up 0.9%, headed for yet another record.
Yeah, and we do have, gold is coming down to 4,000 even, right? If I look at the VIX is coming down to a 15 handle. And so it looks like these safe haven assets, right? Bonds are getting sold across the curve. There's just no bid for them. Optimism abounds.
Well, if you have rate cuts, you have a deal with China, and presumably tech goes okay today, maybe it's safe to jump back in. And those are always famous last words, I realize.
Yeah, exactly. Coming up, it's a crucial week for tech investors. As Dani points out, the biggest stocks in the world are reporting. $27 trillion of market cap reporting this week. 5 of the Mag 7 stocks on Wednesday and Thursday alone. We'll talk about that when we come back with Caroline Hyde from Bloomberg Tech. This is Open Interest.
Let's look at some of the top calls this morning. The analyst action that we are focusing in on. First up, Harley-Davidson, that gets cut to a sell at Morgan Stanley. Morgan Stanley cites limited pricing power, weaker long-term demand trends for the iconic motorcycle maker. Shares down 2.5%. Next up, Truist, they upgrade Booking Holdings. That's the parent company of Priceline, OpenTable. The firm points to Asia's long-term travel recovery, steady GDP growth, and a more compelling valuation. The analysts also say that investors are overestimating AI-related downside risk, those shares up 1.5%. Finally, Guggenheim, they upgrade Microsoft to buy, citing clear AI advantages. Guggenheim says that the company stands out as an AI beneficiary, supported by dominant cloud business and its near monopoly in the productivity suite markets. With that upgrade, Wall Street analysts are now almost universally bullish on Microsoft. Matt, 98.6%, I think is the exact sum of analysts who have a buy rating on Microsoft. That's 72 buys and 1 hold.
Yeah, only 5 buys on Harley-Davidson out of 16 analysts.
That hurts.
They got to get those analysts on the bikes. They need to get Artie Starr out there, the CEO, giving interviews.
Are you saying they're wrong?
Here on Bloomberg? No, I'm not. I don't know, but we need to talk to the company in order to find out. They put out earnings on November 4th. All right. Obviously, Microsoft is a much bigger and more important company to these markets. We're going to get results from Microsoft as well as Alphabet and Meta on Wednesday. Apple and Amazon give us earnings on Thursday. Bloomberg Tech co-host Caroline Hyde is out here with us to help us navigate these massive, massive earnings reports. We're getting $27 trillion of earnings this week, and I guess it's like a Super Bowl for you and Ed on Wednesday and Thursday.
It's going to be a little thick and fast. And talking of the analysts out there at the moment, look, you say 0 sell ratings over at Microsoft. There's 0 sell ratings on Alphabet. There's 0 sell ratings on Amazon. There's just 1 meager one on Meta. And actually, Apple is the only one that's got any sort of cluster of people thinking to sell this particular stock. And what's so interesting is, yes, they're gargantuan in terms of their market capitalization, but actually none of them trade at too eye-watering evaluations because all their earnings have been rising so fast as well. I mean, actually, if you look at the NASDAQ more broadly, it trades at about 27 times future earnings. Well, the only one that's really above that more broadly have been like the likes of Apple and maybe some of the others. But largely, you've seen Amazon, Alphabet, and Meta all trading well below that in terms of their future earnings. I don't think many people feel that the spending that we're seeing and the fury around an AI bubble is actually something to be fighting against right now. Instead, you're seeing advertising wins for Meta. You're seeing advertising strength for Alphabet and the use of Gemini. You're seeing the likes of Microsoft just being able to capitalize on its Azure growth, and many expecting that's going to be in excess of 36% overall. So that growth story when it comes to cloud is going to be bearing weight for Amazon too. This is still signs that the companies are able to outperform right now.
I was going to ask, how much do we care about the traditional businesses? How much do we care about advertising for Alphabet and Meta, for Amazon, for their marketplace? Or is it, what is the return on investment that you're getting in AI, and what big dollar signs are you spending going forward?
And whether we'll congratulate them again for that CapEx. Because in the previous earnings, everyone was really cheering the fact that Alphabet was raising their capital expenditure guidance. Many think that Microsoft might raise it to up to $130 billion for 2026 full year alone. That would be a 45% increase in capital expenditure. That's what Bloomberg Intelligence sees. But they say that they've got the demand there. In fact, what's going to hold Microsoft back is a lack of supply, not a lack of demand. But I do think you're right that actually what's interesting for a lot of these companies is their old business models do still work. Meta has actually really shown that using generative AI within their business, spending and becoming a hyperscaler in and of themselves works for the advertising business model, the flywheel effect, the fact that people are getting more bang for their buck. It also has helped that TikTok's been a little bit under duress of late. But you do see that Meta's probably going to be firing on all cylinders, that Alphabet's still managing to get ad strength there. And indeed, that Amazon does still see people wanting to buy their merchants. So we do see strength underlying, but everyone's just going to want to know about capital expenditure going forward.
I do. When we came in this block, I was looking at the YouTube video from Silicon Valley where the investor says, like, don't show revenue. Obviously, these companies do show massive, massive amounts of revenue and profits as well. So they're already making money. It's not anything like it would have been in 1999 or 2000, but are they getting their kind of return on their investment that analysts, that investors want to see for the AI stuff alone, for the cloud stuff alone?
Well, I think that's when we're going to need to see that Amazon, for example, is still seeing growth in AWS despite that outage that we had last week. Are we still seeing that they're not eroding their market share to some of the newer players? Oracle's come in as a complete powerhouse when it comes to cloud. So how are they going to defend their territory? But a lot of them are still bringing in the types of revenue that you want to see for the investment. And I think capital expenditure, if you're you're looking at it, is coming out of their cash piles. Yes, we've talked about that $29 billion deal done between Blue Owl. I know you've been doing a lot of interviews on that, Dani, and Meta. And yes, you have seen some of these companies starting to raise debt. But more broadly, they sit on such a ton of money. In fact, we're seeing a lot of the pushback on any of these ideas of an AI bubble coming from Bloomberg Intelligence themselves, Brian Doherty writing that actually, for now, they financed it with their own money. You're not seeing suddenly huge debt piles as yet.
It is interesting, though, to start to see some of that off-balance sheet financing. Yeah. Caroline, Bloomberg Tech is going to be must-watch this week. Thank you for giving us a preview of it. That's Bloomberg Tech's Caroline Hyde, where she joins Ed Ludlow at 11 a.m. Coming up, record coffee prices boost Keurig Dr Pepper earnings ahead of its JDE Peet's acquisition. We're going to have more on that next. This is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check on what's going on with stocks. 22 minutes into the trade, we're looking at new record highs, both intraday and if we close at this level there as well. 68.49 essentially on the S&P, 68.50. The NASDAQ 100 trading up 1.3% to 25,680, and you're going to see record highs pretty much regardless of which index you look at. In terms of the stocks that are pushing us up there, Nvidia, although it's not due to come out with earnings until, as Dani pointed out, November 19th, up 2.3%. And that goes a long way to pushing the S&P and the NASDAQ higher. Apple as well, up 1.3%. HBAN is down 2.25%. The Columbus, Ohio-based bank making a purchase for $7.5 billion roughly of a Texas bank, Cadence. As a result, Cadence is up 4.8%. It's an all-share deal. JDE Peet's is little changed. So why, you may ask, do we put it there? Because Keurig Dr Pepper, it looks like, is securing financing to pick up that coffee maker right now. Keurig Dr Pepper up 4.8%. Dani?
They also had earnings. Keurig Dr Pepper, in that, raised its full-year outlook. It was higher coffee prices that boosted its earnings growth. Let's bring in Bloomberg Managing Editor for Global Business, Shelley Banjo, on this. Shelley, heading into this year, or at least after April 2nd when we had all the tariffs, the narrative was consumers hate high prices and they're not going to pay more. But here is Keurig Dr Pepper charging more for coffee and people paying for it.
Yeah, and we've seen this already with Pepsi and other companies. So far, a lot of these companies, they've been raising prices surgically, but really absorbing a lot of those price increases. They're taking it themselves and they're looking to offset those costs in other parts of their business.
So what's the story with the underlying commodities? I mean, coffee prices continue to creep higher, and this is something we've seen with other drinks makers as well. I'm thinking about the brewers. They also had lower volume in terms of sales, but higher prices. Is that the story across the industry?
Yeah, and I think these companies have to account for this. I think you are going to continue to see prices go up to be able to account for this. Now, what is that ultimate, spot that consumers can bear? I don't know. We haven't gotten there yet, but I think these companies are seeing this as more of a longer-term trend than a short-term issue.
Also within this announcement of Dr. Pepper Keurig, in their acquisition of JDE Peet's and the spinoff, they announced that KKR and Apollo would be helping them with a $7 billion investment into it. What does that investment get them and do for them as they look at this deal making and spinoff?
Yeah, so in August they said that they were going to do this $18 billion purchase and then split the coffee business on one hand and the soda business on the other hand, which, if you remember, a few years back, they were the ones that brought Keurig and Dr. Pepper together in the first place. So as Wall Street does, they put things together, then they break things apart. Yeah. After they announced the deal, stock went down 20%. And I think a lot of people were wondering, where is this money going to come from? Are you taking on more debt? What is happening here? And so I think what KKR and Apollo do, and the reason why the stock's going up, is because it sort of gives them a little bit more cash cushion to deal with, to do this spinoff and to do it profitably.
It's so funny you mentioned that cycle, because when I started here in 2000 and companies were building up these huge conglomerates and then they were breaking them up, then they build them back up. And now, I mean, we're going to talk about one carve-out from Polaris in just a second, but it looks like carve-outs are sort of the theme of the day right now.
Yeah, I mean, Kraft Heinz, it just over and over and over again. Now these companies are splitting back apart. And
is it a sign of stress that they're doing this, that this is the trend right now, or is it just cyclical?
I mean, I think it's sort of like the next iteration of things. It's just sort of, cyclical, I guess, is sort of what I guess I'm saying. thing. So it's like the next logical step.
It's the Wall Street money machine.
I was going to say, whether they're getting put together, taken apart, bankers get fees.
Exactly, they get paid. And lawyers, don't forget the lawyers.
And of course, can't forget the lawyers.
Not always, right? OpenAI.
Oh yeah, that's true. Really interesting FT story that OpenAI is doing everything in-house, their own advisors, their own lawyers. So yeah, that's not great for Wall Street.
Shelley, great having you on the program. Shelley runs all of our corporate coverage for us here at Bloomberg, so she sees the trends across the industry before anyone else does. Coming up in the next hour, State Street's head of macro strategy says inflation is not a huge fear going into the end of the year. No one cares about 3% CPI. Plus, Genco's chairman and CEO talk shipping challenges amid the global trade war. This is Bloomberg Open Interest. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. Equity markets trade at all-time highs on the heels of the best week for the stock market since August.
Coming up, trade optimism is in the air. Global stocks rally on the record on news that the U.S. and China negotiators find common ground on a range of issues.
But that bull market faces a make-or-break week with tech powerhouse earnings on deck, plus a Fed decision on Wednesday.
And Argentina's markets surge after Javier Milei's party pulled off a strong midterm victory, defying investor fears of a setback. But we begin focused right here at home on new record highs for indexes in the U.S. ahead of key tech earnings and a Fed meeting this week. Lori Cavlasina of RBC joined us in the last hour.
If you look underneath the surface, the tech sector is sitting up at typical highs on that indicator. Every other sector has decelerated. Things like industrials and materials have actually fallen into negative revision territory. The Russell 2000 has actually fallen into negative revision territory. So it's just a way of saying, look, we had a tremendous amount of earnings enthusiasm and optimism in that last reporting season. It got about as good as it tends to get, and now it's coming back down to earth. It's going to be, I think, make or break in terms of what the tech companies do this week.
All right, that blasé feeling, also noted by Morgan Stanley, is being offset by the Fed cut that's expected this week. The central bank is going to release its rates decision on Wednesday, as it always does. And joining us now is Michael Metcalfe, head of macro strategy at State Street Global Markets. Michael, you're really here to talk about your alternative look at inflation, and that's relevant to the Fed because, well, it would be relevant to the Fed, but the Fed doesn't really care about inflation right now, does it?
Well, look, the Fed is balancing its mandate right now, and it obviously is cutting rates because it's concerned about the risks to the labor market. But inflation being controlled allows them to produce that insurance. And so that's why the inflation data is really important, because the market is very priced for cuts, as you say. It's justifying the equity rally. But will current inflation allow them to do that is the big question.
What does current inflation look like?
Yeah.
A perfect setup.
Is it controlled?
That was good. Yeah. I set myself up well, didn't I?
You did it so beautifully. So what does your alternative data show you, Michael?
Well, so look, this is data that is collected by PriceStats, a company that we partnered with more than 10 years ago, scrapes tens of thousands of online prices every day, and it produces something that fits very closely with the official inflation data. It captures September beautifully. We already have a read on October, which is going to be really important. And it's still the same message. You know, inflation is firm, but it's not frightening. Fed doesn't need to move its inflation forecast. The street doesn't either. So inflation is rising. Tariffs are getting passed through, but so far it's controlled.
So tariffs are getting passed through.
Yeah.
Inflation is still 50% above the Fed's target at 3. It should be 2. And I get that, you know, housing, rent is a help as the market is completely frozen, and really energy prices have been soft. So that's been a wind at our back, so to speak, for the control of inflation. But isn't that set to turn around? I mean, everywhere I look, energy is at a shortage, except for the oil markets, right?
Yeah, so look, I think you're absolutely right. So rent and energy have been important offsets to what we've seen is going to be a little bit of a creep higher in core goods prices, and in particular some of the imported goods prices that we can capture directly through price stats. So, you know, the idea that tariffs haven't been passed through, I think, is incorrect, but those offsets have helped. But here's the thing. So tariffs should be a temporary inflation hit. I think what we're seeing is it's a little bit more gradual than we might have expected. But one of the really important things in terms of the labor market is that you look at, say, for data from Indeed.com, another alternative data set. You look at the wage growth in new wages, and they're at 2.5%. So in other words, higher current inflation is not passing through into higher wage growth. And so that's really important. So the Fed can have some confidence that inflation will still come down next year.
It's another thing where I think, we could be looking at a jump higher in the future because the labor pool is shrinking now, right?
Mm-hmm.
So if you go out looking for a worker, there are fewer to choose from, and eventually you're going to have to pay more as long as the economy keeps growing.
So that's why I think this new wage growth series, which is very, very simple. So you talked about rents, and people are very comfortable that rents are going to come down because new rents inflation is much lower. So same for wages. Current wage growth is still reasonably high, but actually if new wage growth is still much lower, and you'd expect, so if there were labor supply issues, which, look, there may well be in the future, but right now, if you look at the directional trend in newly posted wage growth, it's still going down, not up. And so I think that's why you can have some confidence that actually second round effects simply aren't there in the data yet, and the Fed is fine to do insurance cuts, even though current inflation is high.
On the labor market, it does feel like, Michael, every day there's a new company that's announcing cuts. There was Target last week. Matt and I were looking at this earlier in the show. Last week, there's a story from The Verve saying that Amazon hopes to replace 600,000 U.S. workers with robots, which is
600,000.
A crazy amount. Obviously, this would be over a longer term period of time, but whether it be AI or trying to preserve margins, you hear more and more anecdotally these companies talking about layoffs. But it hasn't showed up in the headline data. I guess we're not getting headline data right now, but so far, it hasn't really showed up.
No, and interesting, and again, Indeed here, actually, their new job postings data has rightly captured the softening in labor demand, but not a collapse. And so I think it is quite gradual. But look, as I said, what the Fed is doing here is you have to remember that policy in the US is still tight, and they're trying to justify getting to neutral, where they can see where these longer term factors will play out. And so I think it's just this counterbalance of having higher than target inflation currently. Will it get passed through to wages? So far, it looks like not. And also, you've got the impact from tariffs. And I think so far, again, it's kind of firm but not frightening, allows them to ease.
By the way, the one thing we haven't talked about in the last hour and 6 minutes of this program is the government shutdown. And it continues to drag on, right? It's day 27 of the government shutdown. Does that matter? Is that going to feed through at all into the economic picture?
Yeah, I mean, it could do. I mean, I think everyone obviously has looked at the past shutdowns and said, okay, well, the market looks through this. It's a temporary cessation activity, and activity just restarts back where it was.
Everything is transitory, right?
Well, it could be. I mean, that's a dangerous word, isn't it, the transitory word? I think that the difference this time might be because the labor market is a little bit vulnerable, that some of the extra government layoffs, if some of them are permanent, might have more of an impact, but it's going to be an impact on sentiment. And so I think there's two things there to watch really closely. One is consumer sentiment, but the other is investor sentiment. So the one thing I can say from our measures of investor confidence is that investors came into this very, very confident, really broad-based risk-seeking activity. We're just beginning, and it's still positive, don't get me wrong, but it's not quite as broad as it was. And so I do think the longer it goes on for, the harder it is for the market to look through it. And obviously, we do have this information void a little bit on the data, which we can fill the gaps with things like price stats and Indeed and many other measures that are out there. But at some point, the longer it goes on for, surely it could be disruptive.
Are you just the most popular man on Wall Street right now with your alternative data in this data gap?
Every dinner party invitation coming to Michael Metcalfe.
Michael, what is inflation?
I mean, look, we partnered with price stats 11 years ago, and this is definitely what we certainly feels like we're at peak price stats. Yeah.
Well, thank you for bringing that information to us, Michael. Always a pleasure to see you. Michael Metcalfe of State Street. Coming up, let's take a look at the markets first, though. We are seeing another all-time high, be it for the NASDAQ, be it for the Philly Semiconductor Index, which you're also looking at the moment. 10-year yields, though, under pressure, higher by 2.5 basis points. It's an optimism over a China trade deal, but we're also going to get a rate cut this week, as we were just talking to Michael about. We'll get tech earnings. So everything's looking good so far this morning, Matt.
Let's take a look at some of the single stock stories a half hour into the trade. From the great state of Ohio, Huntington Bank Shares is going to buy Cadence for $7.4 billion. This is Huntington's second major acquisition in the last month to expand in the South and the latest in a string of deals among U.S. regional lenders.
And we are also watching rare earth stocks. Treasury Secretary Scott Bessent said that he believes China will delay its rare earth restrictions for a year. Critical metals, one of the biggest decliners, down 18.2%.
And some news out just moments ago. Qualcomm is entering the AI data center market, aiming to challenge Nvidia with new chips and computers. The AI 200, I guess that's what they're calling the chip. What a spectacular branding experiment. Set to start shipping next year, and we're going to talk about that.
Yeah, let's get more with Qualcomm's announcement with Bloomberg Tech co-host Ed Ludlow. He's in Washington, D.C. today. I guess on the name, Ed, it says what it is on the label. It's an AI chip.
Right,
just
200.
200, apparently. Just how big of a rivalry will this pose to Nvidia?
Yeah, I mean, the stock reaction, a gain of almost 9%, biggest jump since early April. The stock's now trading at its highest level since July of last year. Shows that this is real. The AI 200 is an NPU, a neural processing unit. It's just a fancy way of saying it's a purpose-designed accelerator card for AI machine learning tasks. And what Qualcomm is saying is that it ships next year, 2026. The first customer is Humane, the Saudi Arabian AI startup. It's basically a holding or umbrella company for the nation's data center build out. And they're committing to 200 megawatts, which is modest in the scheme of everything that's going on. But now as we approach a 10% gain, the market is there for Qualcomm to participate in. It's one that they've not been in so far. So it's a very interesting reaction here.
Ed, you have, as the co-host of Bloomberg Tech and a journalist who just breaks news on a regular basis, a better view than most at the race to beat Nvidia in terms of building chips. We've heard about other competitors before, but how close is anyone coming, and how worried should Jensen Huang be?
Well, again, the reaction in Qualcomm shares shows that the market is taking this product seriously. But it is a small and early entry into a market in which Nvidia holds a monopoly. The issue is that if you take Qualcomm as a case study, it's a future product. 2026 is next year. And the way that Nvidia has been able to hold a lead out over AMD and Qualcomm now entering that market and other specialist silicon names like Grok with a Q, is that it basically has told the market its plans for the next 5 years. So we already know what the next generation GPU from Nvidia is and when it's going to come. And so if you are planning data center capacity and doing deals all over the planet, we already know that Nvidia has future deals in 2026 at the same time that Qualcomm's made this announcement with Humane. And that's the difficulty that these new entrants to the market are dealing with. Then it will become, what is the performance of this accelerator card? Is it better at certain tasks in the inference context than NVIDIA's Gear? We just don't know because it's not yet deployed.
All right, Ed, great to have you catch us up on this, and we look forward to your coverage on Bloomberg Tech. Ed Ludlow there, breaking some news on Qualcomm and on the chip sector that's so important to this market rally. Coming up, we're going to switch gears to geopolitics. Really, though, hitting the bottom line for the markets. Javier Milei's party won Argentina's midterm vote. It's a major comeback out of Buenos Aires, and we're going to go live to the Argentinian capital next.
Yeah, but first, happening right now in Washington, House Speaker Mike Johnson is holding a news conference. We'll continue to monitor any headlines from that on the government shutdown. You can watch that on your terminal. Live go. This is Bloomberg TV.
Democrats to hash it out in October, November, and December. This is not a surprise to Republicans. It's not a surprise to Democrats, and they all know it. That is the only thing they could grasp onto to try to give some sort of argument, to try to give cover for the fact.
Let's get now to high interest. Look what's making headlines around the world. Hurricane Melissa packing 160-mile-per-hour winds, bearing down on Jamaica as a rare Category 5 storm. It would be the strongest ever to strike the island if it stays at that level and does so. The system is expected to bring catastrophic winds and flooding with as much as 30 inches of rain forecast. Losses could reach $16 billion in Jamaica alone. Cuba and the Bahamas are next in its path as Melissa grinds northward through the Caribbean. President Trump dismissed talk of returning to office as someone else's vice president in 2028, rejecting suggestions from supporters to bypass the two-term limit in that way. Speaking aboard Air Force One, he called the idea too cute, saying voters wouldn't like that. He predicted Republicans would have a strong lineup in 2028, led by Vice President JD Vance and Secretary of State Marco Rubio. And Argentina's dollar bonds jumped to record highs after President Javier Milei's party scored a much stronger than expected win in Sunday's legislative elections, easing investor fears over his reforms getting capped in Argentina. The peso also jumping on the news. Markets expected a weaker showing, but Milei's bloc won 41% of votes, securing major congressional gains. President Trump called the victory a big win. The U.S. provided extraordinary backing to Argentina, buying over $1 billion in pesos in the lead up to the election, a bet which appears to have paid off bigly. Dani?
Matt, joining us now live from Buenos Aires for more on that election is Manuela Tobias, Bloomberg Argentina reporter. Manuela, much better turnout and victory for Milei and his party than expected. Why was it such a better result than had been set in for expectations?
Yeah, it's a great question. So just a month ago, on September 7th, the province of Buenos Aires, by far the biggest province, delivered a terrible result to Milei. He lost by nearly 14 points to the leftist opposition. And so markets were bracing for the worst last night, thinking that Milei could even maybe get less than 30%. And he got 41% and trounced the opposition by more than 9 points. So expectations were just so low that he blew them out of the water. And so we're seeing everything rally this morning in Buenos Aires.
What does this mean, Manuela? Does this mean Argentinians who are suffering great economic hardship are willing to stick through the pain of these reforms, hoping to break the cycle of defaults?
It's a great question. Yeah, basically, it means that patience is not up just yet for Milei. We had pretty low voter turnout last night. 68% is low in a country with compulsory voting. So it doesn't mean everyone is on board, but it does give him breathing room in the next 2 years to pass the reforms that Argentina needs to generate lasting growth. So far, Milei has had tremendous success in wrangling down inflation, but he hasn't been able to deliver on jobs or on attracting foreign investment because he needs the Congress for that, and he had less than 15% of seats. Now he's more than doubled his representation in both chambers, which is going to give him a fighting chance to actually muscle through the reforms and give him a fighting chance at re-election in 2027.
You're looking at the celebration that markets are doing right now, Manuela. We're looking at the Argentinian peso stronger versus the dollar by 8.5%. You mentioned some of the roadblocks. How important will those be to overcome to continue a rally that we're witnessing right now?
So even though Milei had an amazing showing, he is still far short of a simple majority in either chamber, even in the lower house. And so that means that he's going to have to come to the table and negotiate with moderate blocs in order to get anything done, really. That got really hard in the last couple months as Milei's rhetoric turned more and more aggressive, even with the most like-minded allies.
All right, Manuela, thanks so much for joining us. Manuela Tobias, they are coming to us out of the Argentinian capital. We have breaking news right now on gold prices dropping below $4,000 an ounce right now. Spot gold trading at $39.91 a troy ounce as the sell-off continues. Of course, I feel like we just came up through $4,000, so it was a quick peak there.
Silver also getting hit really hard today. I should also note that's down 4%. I guess it's optimism over China and that we're going to get Fed rate cuts. So do you really need to hide out in precious metals?
Maybe not as much as you did previously, right? But obviously a lot of people still hold it at
I'm
these
sure
levels.
Costco is still doing well selling their gold bars.
Yes, yes. Still ahead, Nelson Peltz's Trian fund is working on an offer to buy the rest of Janus Henderson. It's just one of the many deals that we have on this M&A Monday. We'll get the details from the head of our M&A team next. This is Bloomberg Open Interest. Nelson Peltz's Trian fund is working with General Catalyst on an offer to buy the rest of Janus Henderson that it doesn't already own. Let's discuss this. Just one of the many deals to break today. Leanna Baker, Bloomberg's U.S. Deals Managing Editor, one of the people to break them. So this is, I guess, just adding to the confidence that corporate America has right now to do M&A.
This is a unique situation, though, since Nelson Peltz has been in the stock for 5 years, and his firm Trian has had board seats, and they've been shaking things up, trying to sort of return this firm to growth. So this is sort of the next step. What's interesting here is that by partnering with General Catalyst, which is they're more known for their tech investments, you know, they invested in Stripe and Airbnb and those sorts of things. So together, these firms want to help the company, you know, embrace AI to sort of drive the next phase of growth. But yeah, certainly we're seeing corporate confidence deals across utilities, banks, FIG, and healthcare all happening in the span of 24 hours.
Well, Janus Henderson is still slightly underperforming. On a total return, it's outperforming the S&P financials, but just, you know, cold hard headlines slightly underneath. What is the decision to outright buy a company? How unusual is it for an activist investor, instead of just owning, I guess, what was it, a tenth of the company or a fifth of the company?
So they're
that
the
had
largest
before go all
shareholder.
in?
They own 20%, so they own, you know, billions here. But taking a private, if you read Nelson Peltz's letter, he says, you know, this is a company that they can make changes behind the scenes out of the glare of the public markets. You know, they could return to growth. And that's just a trend we're seeing across private equity. There's fewer and fewer publicly traded companies out there because, you know, private markets is where it's at right now.
We have the pharma deal today, right? Novartis doing one of the two $12 billion deals we've been talking about. The other one is American Water. But are we likely to see more of these? Is that part of the big M&A boom, the biggest part of it, pharma?
So I'm hearing from our pharma reporter that biotech deals are up 100% year over year. So that's just part of the trend that these big pharma companies are trying to replenish their pipelines with patent cliffs and everything coming up. But definitely, yeah, there's just a lot of deal making happening, decreased regulation in the U.S. There is a Trump bump happening with M&A, and we're excited to see what's next.
Well, we're going to have you on a lot more. I think that's the outcome of that. Two of the many, many deals announced this morning. Leanna Baker, thank you so much. And she's behind a lot of those breaking news on those deals. Coming up next, trade talks between U.S. and China. They steer in the right direction. Equity markets bouncing up higher again off of all-time highs. We're going to discuss the impact with John Wobensmith, CEO of Genco, a dry bulk shipping company. That's coming up next. You're watching Bloomberg Open Interest. Chinese and U.S. trade negotiators lined up a number of deals over the weekend. Those talks come ahead of President Trump and President Xi's planned meeting this week in Korea. Bloomberg reporting that the agreements, however, did not resolve key fundamental issues such as national security. Our Washington correspondent, Tyler Kendall, joins us now from Tokyo, where she's been traveling with President Trump. So, Tyler, what does it seem like was agreed upon in Malaysia over the weekend?
Yeah, hey, Dani. Well, it seems like both sides are trying to tee up some diplomatic wins for President Trump and Chinese President Xi Jinping to finalize when they meet face-to-face on Thursday. But the broad feeling is that this is really just a simmering of recent tensions and a bid to keep the conversation going down the line for a potentially broader trade deal. This week, we will likely see at least an extension of the trade truce that's currently in place and set to expire on November 10th, with the U.S. effectively removing the threat of an additional 100 100% tariff off of the table, seemingly in exchange for Beijing delaying and reviewing its recently unveiled export curbs related to critical and rare earth minerals. The Treasury Secretary Scott Bessent also says that China will resume its purchases of U.S. soybeans, though we have yet to get confirmation on how much and how quickly that will be done. I think it's worth pointing out that we heard from President Trump on Air Force One earlier today, telling reporters that recently launched Section 301 investigation into China's purchase obligations, including for agricultural products like soybeans from the first Phase 1 trade deal, that he's saying that could be taken off the table completely depending on how these talks go with Xi Jinping on Thursday. Now, there's a few other threads we're watching here, but everything that I just outlined really is a pullback of recent escalation from the last few weeks. But I have to say that I have my eye on that 20% tariff that is linked to fentanyl concerns, and it's been in place at this point for months, as both sides say that they are making progress on the issue. Matt and Dani, if we only see an extension of the current trade truce in place, our analysts at Bloomberg Economics say that the effective U.S. tariff rate against Chinese goods will remain at 40%. That is 25 percentage points higher than the global average. So while this will perhaps usher in a period of more certainty amid what has been a lot of heightened uncertainty, there are still a lot of big questions and areas to overcome.
Tyler, appreciate your excellent coverage. That is Tyler Kendall reporting from Tokyo. For a look at how the trade talks are impacting global shipping, we welcome John Wobensmith, Chairman and CEO of Genco. Genco owns 43 dry bulk vessels that operate around the world. John, thanks so much for joining us this morning.
My pleasure.
And of course, the stakes are incredibly high for you because we had these retaliatory port fees put on by China. The Chinese special envoy said that it will be addressed in the talks between Xi and Trump. Are you optimistic that they'll be taken off or some sort of agreement will be reached?
I'm optimistic. You have to keep in mind that there are two sides to this because the U.S. did it through USTR to Chinese companies, which is really what started the ball rolling. And then over Columbus Day weekend, the Chinese put extra port fees in place on U.S. companies. The caveat to that, which we're very happy about, is that even if you're a U.S. company and you have Chinese-built ships, you can go in without any extra port fees, and 85% of our fleet are Chinese-built. So it actually wound up working out okay for us.
But we still have, obviously, the underlying business to worry about. And I wonder how the effect has been of China buying no soybeans from the U.S. They're getting them from Argentina. They're getting them elsewhere, right? We're expecting an agreement on those terms as well. And that's a huge business for dry bulk shippers.
It's a very large business for dry bulk.
Last year it was, I think, $13 billion.
You have the exact right number that China bought from the U.S. China has been buying a lot from Brazil and Argentina. They have been stockpiling. So I think the question, it seems that there's no doubt there is going to be a deal reached on the soybean front, which will obviously be very beneficial for U.S. farmers. And the timing of it, we're just starting to get into soybean season, so to speak. So the timing of it is very good. The question is, do they buy soybeans this year or do they push it off into next year because of the stockpiling that's been done? I think that's, in my mind, that's the real question.
Well, for this Trump administration, a lot of the uncertainty has been a feature, not a bug, and something that they want to use to their negotiating leverage. For you, the uncertainty isn't great. How are you making decisions about shipping routes, what you do with your vessels, when it feels like week by week, sometimes day by day, the decisions from the Trump administration and the Chinese are changing?
I can tell you we are changing our short-term strategy almost daily because of these things, but shipping always finds a way. We always find a way to work around disruptions. And if I can't remember a period in my career when we've had so many disruptions. The Red Sea, the Russian-Ukrainian war, the retaliatory port fees from China. You can go over to the oil tanker side and look at what's been happening there with sanctioning the two largest Russian oil companies. That's obviously causing disruption in shipping in general. So, yes, we are spending a tremendous amount of time on pivoting almost every day.
And the International Maritime Organization wants to push a net zero framework. The U.S. is pushing back against that. How does that play into what are actually pretty low fuel prices right now, right?
Yes, and the IMO, they postponed that decision for a year, and based on a lot of pressure from the U.S., but also from China and Saudi Arabia. And, you know, our view is we have to get to an alternative fuel. I think the big question becomes, how quickly do you do that? Because there just is not infrastructure in place. But ultimately, we think it'll come. We just think it's going to be postponed at this point.
A lot of these things, when new expenses are coming up, whether it's thinking about kind of restructuring what fuel you're doing, new fees from the USTR, from the China side, how do you think about those price increases, what you absorb and what you pass on?
We pass it on. And I can tell you, this is one of, just going back to the IMO, that was one of the concerns that the U.S. delegation had, because alternative fuels are more expensive. The assets to build are more expensive, and most likely that would get passed on to the consumer. In Europe, there is a carbon tax system, and we've been using biofuels as well to have carbon credits, but we've also been passing on taxes where we've incurred them.
You have lived through the, and Genco has lived through the pandemic, right? The Ever Given in the Suez Canal, the Red Sea. Now you've got tariffs, and you've got the carbon issue, the Panama Canal. I mean, does shipping ever get back to normal? Is there ever a time where you can just kick your feet up and say, like, smooth sailing from here on out?
Well, I can tell you, I've never kicked my feet up in shipping, but hopefully things are resolved a little bit more. I think.
But this period has been intense, right? The last
like I
5
said,
years.
I've never seen anything like it in my career. Again, that's the nice thing about shipping. There are pivots, there are workarounds that you can do, which we've been, extremely focused on.
Well, just to that point, let's say an agreement is hashed out between Presidents Trump and Xi that restores soybean purchases, that helps with some of the retaliatory port fees. Does this industry go all in, or do you think that there's still some hesitancy and some stickiness to the rerouting of shipping that has already happened? Do you think that this is an industry that's willing to just say, okay, we have the all clear?
Well, so no, I don't think we'll ever have the all clear. I just don't see that. And I think the Red Sea issue, it all sounds wonderful to think that that is going to open up soon, but I can tell you we're going to be very hesitant before we do anything. We're really going to have to wait and see the results of that. But shipping in general is setting up very nicely from the supply side. And if you look at dry bulk shipping, 10% of the fleet is 20 years or older, so getting very close to the end of their useful life. The order book is only 10%, so it's very, very low. And building ships today, you're talking about 2029 type deliveries because all the berths have been filled up. So aging fleet in dry bulk for sure, in other sectors as well, and scrapping will have to occur, and ultimately the fleet will have to be replaced. But that's a little ways out, so I think we have a few good years here.
What do you think about fuel prices? I mean, I look at, on the terminal GLCO, and I'm just looking at crude, and obviously you're using diesel and some big heavy fuel that I don't even know about, but the trend is down, right?
Definitely.
Does it continue?
Yes, definitely. I mean, look, we've seen a spike in oil prices lately, so I assume that's going to transfer into bunker fuel, just like diesel. But it does seem that OPEC is producing more and more volumes, which is, keeping prices lower than maybe they would have been otherwise.
All right, great having you in. We love to get your intel. You have one of the best seats in the industry to tell us what's going on. John Wobensmith is the CEO of Genco. Let's get a check on what's going on in the markets right now. An hour, 10 minutes into the trade, we're looking at all new record highs, both on the intraday level and the closing level, 68.54 on the S&P 500. The NASDAQ up 1.5%, adding 378 points. And you can see there's a sell-off in treasuries as well. Gold is down. No one cares about the downside, tail risk. Everyone is taking off hedges.
Yeah, no one cares. Inflation is still at 3%. Who cares? Everything is great. Tech earnings will be wonderful. A deal with China on its way. And there are some single stocks moving this hour. Qualcomm is entering the AI data center market. They are aiming to challenge Nvidia with new chips and new computers. AI 200 is set to start shipping next year.
Keurig Dr Pepper raised its full-year net sales outlook, with focus turning to the beverage maker's planned takeover of its Dutch counterpart, JDE Peet. You can see those shares up another 7% today.
And Lululemon has entered an agreement with the NFL and sports merchandiser Fanatics. They will be developing a line of fan apparel. It is their first link up with the leagues, and Joe Montana will be their spokesperson.
So wait, is Lululemon going to sell like jerseys then, or NFL-themed yoga pants?
That would be weird. Maybe, but I'm assuming it's more like a nice little quarter zip that says like Chiefs on it or something like that.
All right, okay, cool.
I don't think they're going to put Joe Montana in NFL branded yoga pants, basically, is what I'm saying.
But Montana's their spokesman, but everybody's going to want the Travis Kelce gear, is what you're saying.
Yes.
Because of Taylor Swift.
Yes.
Coming up, private equity firm Carolwood is set to take over Indian Motorcycles from Polaris. It's an iconic brand that maybe hasn't been so well taken care of. Is this the boost they need to take over from Harley-Davidson? We'll discuss the future of Indian next. This is Bloomberg Open Interest. One of the most iconic brands in motorcycling is getting new owners. Los Angeles-based private equity firm Carolwood will buy Indian Motorcycles from Polaris. The deal is expected to close in the first quarter of the new year. Carolwood has tapped Michael Kennedy, a former Harley-Davidson executive, to run the company. And joining us now to talk about it, Spencer Towill, Carolwood head of mergers and acquisitions. And Spencer, it's great to have you on. For me, this is exciting because, well, number one, we've been covering carve-outs a lot from private equity. It's a growing trend. But number two, I'm a huge motorcyclist, big fan of the Indian brand, and I feel like it has been neglected to some extent under Polaris leadership. What will you do differently?
Yeah, so first of all, Matt, thank you very much for having me. You know, on the carve-out market, I believe that's an ever-evolving thing, and with the current market volatility, we're seeing more and more of these transactions, obviously. We've been looking at the Indian business since early this year. We're extremely excited to be the new stewards of the brand. You know, on what we would do differently from Polaris, I'd say strategically, right now we're focused on separating the extremely large amount of entanglement from the parent company, and looking forward to telling you a lot more about our strategic plans in early 2026.
It was never clear, by the way, Dani, you know, Polaris has snowmobiles and side-by-sides, and they had Victory, which was another brand, and Indian, and you just never really knew that there was one leader taking one company forward. So that's why, to me, this is...
It feels like that's happening a lot, right? To your point, I mean, we're just talking about it with Dr. Pepper, Keurig, that's looking at breaking up and spinning stuff. When you look at the general deal environment right now, we'll get back to this specific deal in a moment, how many of the opportunities are that in maybe bloated companies that have underappreciated assets that they're just sitting on?
So for us personally, about 85 to 90% of our pipeline is corporate divestitures. I think that is a growing portion of the trend. I think when markets become volatile, people like to tighten up their portfolios and focus on their core businesses, which for us is a massive opportunity.
I look at this bike and I think you would be able to take a lot more market share from Harley-Davidson, would you, if you were going to make certain moves. And this is something that obviously a lot of companies have tried and failed at. I think of Ducati, for example, putting out their X Diavol. They really wanted a share of that cruiser market, and I'm not sure how much they got. What do you think the chances are that Indian can do as well on the street as it has done on the racetrack?
I think the chances are high. I think we have a market-leading product, a great portfolio of models at this point, and an incredible, passionate team who actively wants to take market share from our counterparts in Milwaukee. Absolutely.
Can I ask just how different this deal is for you? When I think of Carolwood, you've done a lot of real estate investments. Is this a turn to focus more on sort of consumer branded type deals and companies?
Yeah, so for myself, my background is not in real estate whatsoever. There's a completely separate team at Carolwood that focuses on real estate. I've been looking at special situations and corporate divestitures for the last 5 years. When I joined the platform in January and began speaking with our two founders at the end of last year, we kind of built out some infrastructure and more importantly, in my opinion, some third-party relationships that are critical for doing these types of deals, specifically to target these types of transactions this year. So for me, this is all I work on.
So you're leading the charge, basically.
Absolutely. Yep.
You know, if you look at the economic backdrop, one of the problems with motorcycle sales, not just at Indian and Harley and Ducati, but across the industry, has been they're very expensive, right? For the average kid, and that's the buyer you want to go out and pick up new. So how do you solve that problem, and what does the economy look like to you in terms of the consumer?
The economy, again, is volatile right now. I believe with a strong enough product and the incredibly passionate rider base that we have, those two things are able to cut through that volatility fairly well. Again, of course, market volatility and tariffs were a large part of our diligence process. I think anyone looking at complex global manufacturing businesses would say the same thing. But again, we believe in the strength of our product to be able to cut through that.
I wonder if it's just about motorcycles, because I go to the store, the Indian dealership in White Plains, and obviously I want the bikes, but also I want the hat and the jacket. And I mean, you could sell so much with that brand because it's so old, because it's so iconic. It makes me think there are other products you could branch out into.
Yeah, absolutely there are. We definitely have plans to grow our apparel business in the new year.
He's not sharing with me. I know he knows what he wants to do, and he's not.
Well, wait, okay, how about this? So I know it seems crazy to talk about an exit because you're just buying it, but you don't come up with a thesis without thinking about what the exit looks like too. What does an exit strategy look like for a company like this? Is it a strategic buyer? Is it a return to public markets? What's the game play?
I think that's a great question. So,
and you're not going to answer it, or?
No, I'm absolutely going to. So Carolwood's fairly unique in the sense that we actually are an independent private equity firm. We have no institutional investors. We source all our capital internally. Because of that, we are able to take a longer kind of time horizon approach to our deals. So we do not have a 5 to 7 year exit strategy for this business. We are a long-term holder. And so when we think about our thesis, we think about developing strong, consistent growth and strong, consistent cash flow first before we start thinking about an exit.
You can, in terms of what you do want to do, or what you don't want to do, you can take lessons from Harley-Davidson recently, right? Because they brought in this German shoe CEO, Jochen Seitz, I think he's a great guy and he's done some great things, but the base wasn't a fan, right? He had this huge DEI push. He wanted to make a lot more things in India and maybe Vietnam. And I guess you've got to focus on American-made here, don't you?
Absolutely, we do. Bringing in Mike Kennedy, who's going to be the new CEO of Indian, was a critical part of this deal for us. Mike is a titan of the motorcycle industry, in our opinion. And again, we are humble enough to understand that we are not experts in the motorcycle space, and so having him as part of our team makes us incredibly excited. He's been in the motorcycle business for 30 years. He was at Harley for 26 of those 30 years. He certainly knows their playbook very well, and so we're extremely excited to have him as our new leader.
What do you think about the flat track racer? You know, because the focus is always on these big, heavy touring bikes, and I feel like Indian brought out something almost revolutionary, and then Polaris didn't really put all of its weight behind this little bike.
Yeah, so the flat track racing and kind of FTR play by Polaris in general was something that came and went long before we were ever in discussions with Indian. So I can't comment on their play there.
So Spencer, you're coming back and you're going to let us know when you can give us all these strategy updates, right?
Absolutely. I think we have a ton of exciting things that we can share in early 2026, both on the racing and beyond.
Well, we can't wait. I'm sure our viewers can't wait either. Spencer, thanks so much for joining us this morning. Spencer Towill of Carolwood. Coming up on the show, we're going to set you up for your trading week ahead. This is Bloomberg Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. After a record close really across the board on Friday, we're looking at a rally on Monday. S&P 500 at 6850 now, and the NASDAQ up almost 1.5%. You can see even the small caps are up, though not as much. The Dow gaining 0.5%. Take a look at Nvidia right now, up 2.2%. These gains have been pretty steady all day long. Qualcomm is a different story. Ed Ludlow and the tech team breaking the news that they're going to try and make an AI chip rival to Nvidia. They've already got a customer in the Saudis. HBAN buying Cadence Bank, so it's an all-share deal for $7.5 billion. Huntington down, Cadence up. And then you've got Avidity Biosciences gaining 43% here on a purchase from Novartis. That's a huge premium. And then Keurig Dr Pepper up 7% on earnings and after getting Dani, funding for JDE Peet's deal.
So a lot of deals in there, but in general, it's a market that is rallying, and it's remarkable that it's rallying because there's a lot of event risk just this week. So tomorrow, we're going to get the earnings parade continue. We'll get United Health and UPS reporting results. Wednesday, you get the Fed decision, blind on the data, but likely to cut. Plus tech earnings, we get results from Microsoft, Alphabet, and Meta. Then Thursday, President Trump and China's Xi Jinping will be meeting in South Korea. And then we'll get more tech earnings, Apple and Amazon. And again, no fear, rallying at record highs heading into all of that.
All right, coming up tomorrow, Ethan Devitt of Moneta, as well as David Costin of Goldman Sachs, plus Apollo's co-president Scott Kleinman and Merlin CEO Matt George. It's a fully packed Tuesday for you. One day ahead of the Fed, this is Bloomberg Open Interest.